Okay, welcome to the Enigma Weekly Review and Slingshot Hedge Q&A. So today is the 18th of November. Hard to believe it's almost Thanksgiving and coming up on Christmas. So Luke, you've been doing the slingshots for I guess 2 weeks now and have some performance data for the service and also your historical stuff and I guess some questions to answer. So let's get it going with the Q&A. So thanks for everything you're doing, and hopefully you can get some questions answered.
Okay, thank you, Tom. Yes, so what I've prepared for today is basically like 7, 8 different items or questions that people have been forwarding to me or I've brought up. So we'll dive right in. So of course, with regard to the Enigma options of the Slingshot Hedge, we've covered that in a previous presentation, the one of November 4th. And of course, people can review that if they want. For today, basically, I have the following questions that I will try to answer. And of course, if there are any additional one, I'll be very happy to try and answer them. So the first one is, of course, what is the real investment philosophy and the trading strategy behind the Slingshot? So it has to do with the fact that we're using Enigma. Enigma is really a program, a strategy that I've developed over the years. And it's trying to hedge and protect and basically try to safeguard the portfolio as much as possible. Why? Because I call it an exercise in managing ignorance, because we don't know exactly what we don't know. So everything that we do is based on research, and all the signals are, of course, research driven. So we start from the assumption that the market is long-term quite efficient, but in the short term we have plenty of inefficiencies, and that's what we try to exploit using 3 different trading engines or trade algos, momentum one, a bias one, and a hedging one. I've explained those before, so I'm not going to repeat myself there. And then, of course, the second key question is, what are the real features? What is Slingshot all about? So it's directional trading using the S&P 500 futures as a basis. So it's a time series on the S&P futures that we use as a driving force to generate a trade signal. And it is directional. So it's using some long delta or short delta, in other words, long gamma exposure with every single trade that we put on. We will use options on both the ES, so futures options, and or options on the SPX to implement signals from the futures trade series. A key feature, of course, is also that apart from the fact that we're using long gamma, so short theta option structures, we will also have maximum risk, known maximum risk at all times, and at the same time, uncapped profit potential to the upside or to the downside, depending on the trade direction, of course. And we'll be using different time frames, and I'll come back to that in a moment. So the real foundation of the Slingshot is that we first of all need to come up with a very clear and defined trading edge. Without that, it's very difficult to do some directional option trading, because then we're like pointing in whatever direction without any, just based on feel or an opinion, whatever. So we want to avoid that at all price. We use only something which is research driven. And to have this directional trading, we can use different structures, but the one I prefer by far is what I call the Slingshot Hedge. And it is, and we'll talk about this, of course, in detail. But so in essence, we start with an edge that we have developed using these trading algos. Then we build a trade structure around it. And then most importantly, we try to control the risk at all times. So that's why with the backspread that we start with to build the Slingshot Hedge, we have, of course, an implicit limited risk and known maximum risk from the start. And we keep that risk at all times, and we start to lower it as soon as possible. So now, if you look at a simple textbook example, so as I mentioned before, we can build a Slingshot Hedge either with puts or with calls, even with a combination of the two. But visually, it looks simply like a butterfly with an additional leg, so-called kicker. So If you would have a simple butterfly structure, it would be +1, -2, +1. So we buy 1, we sell 2, we buy 1. They are equidistant. In other words, it's symmetrical butterfly. So no broken wing or whatsoever. It's really purely symmetrical. And we add an additional lot to the furthest leg. In other words, to the wing which is furthest away from the at the money. So in the example here, it's an example with puts. We have the 43.70 that we buy. We sold 2 of the 43.60 and we bought 2, not 1, of the 43.50. So if you do that, of course, it would cost us some money because a butterfly, first of all, is not free. And if you then would add an additional leg to the furthest away wing, it will, of course, even cost a bit more. So we try to build a slingshot hedge starting with a different structure. And how do we do that? Well, there are different ways, but one which is really simple and the one we will be using most of the time is where we start with a back spread. So in other words, we buy 2 put verticals in this example, and then we add a kicker. In other words, we start with +2 puts. What I call the P1 is the first put, and sell 2 of the P2. So the second put, and the first one is at the money or around the at the money level, and the second one is a bit out of the money. So for example, it could be a 50 delta 1 for the first put, and it could be like a 40 or a 35 delta for the second put. Now, at the same time, we add a so-called kicker, and so we buy an additional 2 of a third level, in this case, the third put, which is at 43.50. And that could be maybe around 20 delta, depends on volatility, on skew, and so on. But it's an equidistant structure. In other words, the distance between the first and the second put is the same as between the second and the third. So then we have a certain investment, which is at the same time the maximum risk. In this case, it is $1,950. That's the most we could lose if, say, the market would go against us and we would not do anything, or we would forget to do something or whatever. So we can't lose more than that, of course. Now, the purpose of the game, of course, is not to wait and see, but to take action when the market starts to move. And if the market goes in the right direction, in this case to the downside, we will wait for this positive excursion to actually bring the delta exposure down. In other words, reduce the delta exposure. So if we have like a -100 delta, we will probably then end up with a -30 or -20 or -60. And we do that as soon as we can sell out one of the original at the money puts and then actually get into the structure +1, -2, +2. And so at that point in time, it becomes usually a risk-free trade where we are, in this case, short delta, long gamma, as we always will be, short theta, and usually also long vega. And that's how we basically structure the slingshot. Now, the third question has to do with what kind of markets are we trading? What kind of size are we trading? What is the planned capital? And what time frames are we using? So many questions into one question, but it's pretty easy to answer. So what markets are we using? Well, we can apply it in both the E-mini S&P futures options as in the cash index SPX options. Of course, the first one is half the size of the second. So we could try the SPX, we could try the ES. It doesn't really matter, depending on the account size, on your risk profile, and so on. I usually trade SPX, but at the same time, I will be doing some ES options so that I can show the fills in both markets. In terms of trade size, to really be able to do all the adjustments that we will be doing during the trade, or that we can do for a given slingshot hedge, we need at least 2 contracts per unit. In other words, we can't really trade with a +1, -1, +1, because then we are a bit limited in terms of adjustments that we can do. So we could do +2, -2, +2 to start with the back spread, and then actually start playing with that unit. Now, of course, if you want to trade in smaller size, you can always use SPY options or XSP. So in other words, XPS options, so you can use the really tiny 1/10 of the size of SPX, or the micros. But of course, I expect the liquidity to be less good compared to the ES and the SPX. In SPY, it's probably very decent, but of course, you would pay much more in terms of commissions. But if you want to try this out with smaller size, it can be done, I think. In terms of planned capital, so what we have to plan per Slingshot Hedge trade is something like $3,000 in the ES and $6,000 in SPX. Why? Because the second is, of course, twice the size of the first one. And the trade, looking at the different trades, the risk of the trade, the different adjustments that we do, I think it's comfortable to have like 3,000 for all the ES trades and twice that amount in the SPX. And that could then be using an account size of, for example, $20,000, so that we can have, for example, several losing trades without really getting into a situation where we couldn't trade any longer. So from a risk-adjusted point of view, it's important that we have an account balance which is sizable, in this case around 20K, to then trade the Slingshot hedges without any problem. In terms of time frames, so we can trade Slingshot in various time frames. I'm using them on an intraday basis, on an intra-week basis, and it's what I call the 2 weeks up to 14 days. But I also use them on very long term, like 5 months, 3 months, even longer than 5 months occasionally. And the results are quite good. Of course, then we are putting up much more initial risk from the start, but it definitely is still valid across these longer time frames. And I'll show some examples later on, maybe. In terms of risk management, I mentioned it's really key that we try to control and manage the risk as good as possible, because without that, even very good trade ideas can turn into a losing proposition. So that's why we really need to control the risk at all times, because we can't really control the return. And the whole purpose of the game here is to build convexity into the trade at a reasonable cost. And that's why risk management is so important. Now, what we do, well, as I mentioned, capital preservation is key. So we try to prevent really big losses. So we don't want to see our, say, 20K account going down by $5,000 or $10,000. We don't really are afraid of volatility, because we actually need volatility, because we need movement, because remember, it's a directional trade. And that's why at the same time, we want to be hedged. In other words, we have to know our maximum risk at all times, so we don't get into a situation where suddenly the account is losing 20, 30, 40, or even more %. So that's to be avoided. And that's why we have these back spreads and maximum risks from the start. In terms of portfolio construction, well, we will be using really effective diversification. We don't really try to find or search for low correlation, because correlation is not really stationary, it's changing over time. And because we're using different algos and different time frames, and at the same time overnight trades and intraday trades, we have a lot of diversification built in. Now, of course, with Enigma, which is behind the Slingshot, we have different algos working at the same time, and I'm trading about between 5 and 15 positions at the same time. But that, of course, becomes like a full-time job, which it is for me. But of course, we can't really do that, because it could become very complex and less transparent. So what I've discussed with Tom, what we'll be doing is that we will never have more than one open overnight position which is still unhedged. In other words, if we have a position and we have been able to convert it into a no-risk, a risk-free trade, or we have converted it into a butterfly, in other words, we know from that point onwards that there is no more risk in the trade than what we can see here. It's locked, in other words. Then if we have a new signal from one of the algos, we could add an additional overnight position. So we could simply have a situation where we do a trade in the morning. After a couple of hours, we have been able to change it, morph it into, say, a butterfly or a risk-free trade, and then a different signal comes along, we will take that second trade as well, because the first one is now without any risk. Also, if there is a day trade signal, we will be doing the day trade, because we know that before the end of the day, we will be out at the latest, at the close. So that at the end of the day, after the bell rings at the close of the regular trading hours, we will never have more than one open unhedged position overnight. We could have several other positions, overnight positions, provided they've all been hedged or with locked-in profits. So that's the strategy in terms of potential allocation. In terms of differences between, because the question which was asked was, I'll just go back to that quickly. So because you are trading question 5, you see, if you are trading directionally, then why bother using options? Why not using futures? And of course, it's a very valid point, because actually we see there are benefits trading futures or benefits trading options, depending on what you feel more comfortable with. So on the option sides, using the slingshot, we have, of course, this asymmetric risk return, which is, in my opinion, a very big advantage. With the futures, of course, it's delta 1 trading, so it's 100 deltas. So it's plain vanilla, it's linear, so it's straight up or straight down. The market goes up 1%, you make 1%. When you're long, you lose 1% when you're short. With options, of course, it's asymmetric. You have some built-in maximum risk from the start. And the beauty, of course, is that with the delta that you have from the start, it will be increasing. Imagine that your long days +1, -2, +1, as we've seen in some of the examples. Well, then, of course, if the market is going your way, the delta will start to increase more and more. So you will end up with a bigger than initial delta. And so that way you will have even more profit potential than with the futures. And by the same token, if the market is going against you, well, your delta, of course, will start to decrease in absolute value. So you have this built-in asymmetric risk return. So the built-in convexity, as it's called. Now, in terms of execution, it's slightly more complex, because you will have different legs, probably 3 legs, sometimes even 4. And we'll do some examples of that over the next couple of weeks, definitely. And in the future side, on the other hand, it's a very easy trade, because it's just one leg. You buy one future or 2 futures, and you sell them. So there is no complexity there. In terms of execution, it's very hard to beat the execution facility using futures. It's a very good and simple execution to buy or sell futures. There is huge volume, more than 1 million contracts a day are traded. You have little or no slippage, maybe 1 tick, or sometimes during wild times, you may have 2 or 3 tick slippage, but it's really exceptional. I've done very significant size, and slippage was never more than 2-3 ticks in the futures. While, of course, in the options, depending on the expiration, depending on the strike, it can be slightly more difficult to get a fill, or it could take a bit longer. And of course, the bid-ask spread is definitely wider than in the futures. In terms of trade management, it's more complex, the trade management with options than with futures, but we'll try to keep it relatively simple. And we'll usually stick to 3 or maximum 4 different strikes. And we always stay within the same expiration with a single trade. So we're not going to use any calendars or time spreads to manage the risk. So then another important feature is, of course, how about the performance? Now, as this Enigma Slingshot is built off the futures algo, so I can show the futures performance since November of 2020, and it's pretty decent. I must admit, of course, it's volatile. You can have some drawdowns, of course, as with every single system, I think, but on a risk-adjusted basis, it's quite powerful. With the options, I assume that the risk-adjusted performance is going to be even better, but of course, Why? Not so much because you will make more return, but I think on a risk-adjusted basis with less risk, you will make a comparable or slightly lower return than in the futures. But you can better control the risk because you won't have any nasty surprises like overnight gap risk, which of course is inherent with the futures. Imagine we have an open position in the futures on a Friday, and on Monday the market opens down 100 points. Well, of course, even if you have a stop, it doesn't matter, you will get filled at market. So it could be a pretty painful experience. And as you can see here, there was one painful experience where you see a losing trade of about 13,000, which was of course a gap, which happened once. So these kind of things do happen in the futures, while in the options it's totally excluded because you have this built-in limited maximum risk, because the premium you paid is the most you can lose. So it's a system where you will make about a profitable trade about half of the time, slightly less, about 45% of the time, as you can see here on this snapshot from the NinjaTrader strategy performance. And the good news is that although you make money less than 50% of the time, the average winning trade is quite big compared to the average losing trades. It's a ratio of more than 1.5, actually around 1.8, as you can see. And it's very symmetrical in terms of long trades and short trades. That's why I like the system so much, because it's not really dependent on, well, is the market going up, then the system is working fine. If the market is rather down or in a short mode, short bias, then it's not really performing. Now, on the contrary, as you can see, it's about 50-50 between long trades and short trades in terms of both number of trades and in terms of profitability and in terms of total P&L generated. In terms of frequency of trading, you can see it trades about 3-4 times a week, 0.71 trades per day on average. So it's in the market about 1 day, 2 days, sometimes up to 7 days, but sometimes it's even exiting within the hour, as we have actually seen in real time a couple of days ago, I think, when it was in the market for like 17 minutes, which is really exceptional, but it does happen. So it's a pretty decent program in terms of performance. I have some more numbers here. Average profit per month, that's per 2 ES futures equivalent. So I was using 100 deltas, so either 2 ES futures or bringing the position to 100 deltas from the start, which is basically one SPX unit, I'm sorry. And so that's consisting of a back spread +2, -2, +2 at the start. And it made about $9,000 per month. Now, how many trades will we see? On average, we will have about 8 trades, position trades, I call it, or overnight trades per week. And on average, we will have about 3 day trades additionally. So we could count on about 10 trades a week. Sometimes it's a slow week. For example, if the market is trending very strongly, like we have seen in early November, well, then if we happen to not be in a trade, well, then it's very difficult to get additional signals. In other words, once you're in a very strongly trending trade, it's likely to stay in that trade for like 2, 3, even 4 days. And then it's just showing less trading activity. In terms of the average trade, it's about $306 in the SPX, with an average win of about 1,850, average loss of slightly over 1,000, and the maximum expected risk per trade in SPX is $3,000. So in other words, that's why 6,000 is really very wide in terms of planned capital per trade. As you can see here on my snapshot from my portfolio, you see on the SPX, I'm using it on different time frames, even very far out, up to, say, April 18 of next year. So across different time frames, I can use the same kind of strategy, of course, with a very similar structure. So using this Slingshot Hedge. So I think that's one of the other questions. And of course, then the pricing of the Slingshot. So we discussed it, and we will go for $500 for a full quarter for the trade signals plus the general discussion via Slack. If people want to combine it with the Enigma Futures service, which is of course a separate alert service, we will do that for $750 per quarter. So that's the pricing of the service. So let's see if there is any question. In the meantime, let me just go back to my other screen.
I don't see any new questions.
Okay. Good. Then I'll go back here. So, Tom, you have some other points you wanted to raise or mention?
Just I think we were extending the trial another week, weren't we?
Oh, yeah. So that we can do that, say, till the Wednesday, including the Wednesday, because the Thursday is a holiday and the Friday is like half a day, and I won't be trading on the Friday. So we can add an additional 3 days there, I think.
Okay. And then let everybody have a good Thanksgiving, and then we'll start
Exactly.
it the following Monday. Yep.
Absolutely. Yep. So, and with regard, maybe I should explain a bit more with regard to the trading signals. So as there are these 3 different algos that generate trading signals at all times during the trading hours, and I mentioned we will only have one open unhedged position. So if a new signal comes in while we don't yet have the current trade hedged, we won't take it. So it's only when we have, of course, a hedged position that we can add a new overnight trade to it. So it's not that we will be having 20, 30 trades a week. We will just be very strict about it and only add a new open position so that people know that, okay, the planned capital is 3,000. We will not end up with 7 different open positions, and each of them should see $3,000 in ES per trade or something. So it's going to be limited and strict to this only one open overnight position, which is still unhedged or not yet locked in. But as soon, of course, that we have a trade locked in or fully hedged, like converted into a butterfly, for example, then we will be taking the next signal that comes along and do that as well. So people should not be afraid that there will be too many open positions at the same time.
Is the suggested account size, is that for ES or SPX or both?
That's for SPX.
SPX, okay.
Yeah, absolutely.
And I had a couple problems getting executed on the 4 -4 +4 setup and
Really?
Thinkorswim. Getting into the trade was no problem, but when I tried to sell that middle strike again to convert it to a butterfly, I had the order rejected on 2 different days. It said, "Are you going to exceed your margins?" Like, well, no, I'm not selling naked options. It was they couldn't figure it out. So in that sense, ES may be better if you're having troubles with that kind of stuff.
That is correct.
Because it's span margin and it's usually never a problem, but just a little gotcha there. I did experience that twice with Thinkorswim.
Okay. I'm using interactive brokers. I haven't had these kind of issues, and I've been doing this for quite a long time. So
it might have something to do with the Schwab takeover. I don't know.
Could be. But your point is very valid. If you would do this on ES, it probably should not matter. Also, the adjustments that we do, sometimes we will simply box it off, the trade, the open position we have. We will basically lock it in by turn it into a box, and at the same time add an additional, say, call debit spread or something. So in other words, 4 or 5 legs. It's not an issue on ES, while in SPX you usually then have to split it up into at least 2 different orders. So it's definitely easier to execute. And if you would do single orders, of course, in ES, as you know, it's always a multiple of 0.25. However, if you do the combination, then it's like a 0.10 or 0.05, depending on the prices. So then it's not too far different from what you could get in SPX. Well, if you do single options, then it could.
Yeah, the spreads and futures options over $5 or 25-cent increments, but it's also half the price of SPX, so it's like 12.5 cents.
True. Yeah, absolutely.
And then I would also say for the suggested account size, you might want 25,000 in there because you may run into the pattern day trader restrictions if you're doing SPX. If you have less than
Absolutely.
25,000.
That's a good point. So I'll change that to 25. Yeah. Then we get rid of that. Okay. And of course in ES there is no pattern day trade rule.
Oh, and then Luke asks if you could show us and explain the signals on Ninja.
Okay. Now let me see if Ninja is up and running. No. I'm sorry, because it's still loading. Now, let's see if I have a different one. Let's see. Because Ninja takes an eternity to load the data, especially if you're using volatility bars or Renko bars or something, and quite a lot of history. So let's see if there is anyone which has been, I think there is one. No.
You need my fiber optic connection. And we
I
got
have a
2
fiber
gig.
optic connection.
Oh, you do? Okay.
Oh, yeah, since many years. Yeah. Yeah.
Well, they're just rolling it out to the whole city of Colorado Springs. So
Okay.
$85 a month for 2 gigabits per 2 gigabits per second.
So, but this is on euro, but it's basically can be applied to different time frames, of course, as I explained. But I would like to show it on this one, but it has not yet loaded. No.
And then while you're doing that, Ron asks, so just to be clear, when we first enter the trade, are we entering as a back spread or as a butterfly with an extra kicker?
Okay, very good point. So just go back there. So when we build the slingshot, we always start not with the slingshot itself. In other words, we don't start with a +1, -2, +2, but we start, for example, and in most cases that will be the case, we start with this +2, -2, +2. In other words, so a call or a put debit spread, so a normal vertical, and an additional third leg, which is also 2 units. So for example, we buy 2 puts, sell 2 puts, that's the put vertical, and then the kicker, so adding to the vertical to get more delta exposure, 2 of the third leg. So that's how we start, and then we wait for the market to move. If it's going in the right direction, we can then change it into a slingshot hedge. For example, we sell out one of the at-the-money puts, and I should give an example that's probably easier. So let's take an example here of a trade we did, actually. Yeah. So I think that's a start. So you see here, and you can see my option.
Yes. Mm-hmm.
So option at Explorer. So we start here. Well, it's not 2, but we could do this, of course, with +2, -2, +2. This is now with a 4 lot, as we did in Slack, +4, -4, +4. So that's how we start. So you see that's on calls. So in calls, it's the 43.70, 80 that we bought and sold. And we added an additional 4 lot of the 43.90. So we could do, of course, the same thing with +2, -2, +2. But here the example is with +4, -4, +4. So you see the maximum risk at the start is 3,800. So that's the premium that we paid. And what did we pay? I'll just pull up the... So it's basically $19 for the back spread in calls, BSC. So these are the prices that we paid, $19. So times 50 times 4 is basically the $3,800 that we paid. Fine. So that's the starting position. Then we need the market to move. And let's see what's the next step. Okay, so what happened here is we basically converted the back spread in the calls into a call debit spread. And how did we do that? We basically collected $39. So what happened there, as you can see, of the 70 call that we bought initially, the 4 contracts, we sold them out. So we collected money for the selling of the 4 4370 calls. At the same time, we also bought back, the 80 call. In other words, we bought back the 70 and the 80, which we started with. So the vertical 70-80, we basically sold it out. And then at the same time, we additionally sold 2 more of the 90 calls. So we had 4 of those at the beginning, as you can see here. So we bought of the 90 calls 4. So we had 4 of the 70, short 4 of the 80, and long 4 of the 90. So we closed out the +4 -4, the 70-80, which is this one. And then we sold the 90 call as well, 2 of the 4 that we bought. So in other words, we are left over with 2 of the 4390 calls. Additionally, we sell 2 of the 4400 calls. So now we have a vertical 90-400. So 4390, 44-100. And that's this visual representation. And at the same time, as we have collected more than enough to pay for what we initially put on, so the $19 times 4 times 50, now we have collected $39 for this trade. And in other words, we have now collected $100 extra compared to what we paid for. So it became a risk-free trade. So as you can see, worst case scenario, we will be closing the trade with a $100 profit. Now, of course, at this point in time, the market is up and we're up about $450. And then the next step that we do, given that we have now a call debit spread, we will convert it into a butterfly by selling an additional one of the 4400 and buying the 4410. So now we'll go to the next step. So, and here we are. So now it's a couple of moments later. We have sold an additional 2 lot of the 4400 and we bought a 2 lot of the 4410. So from the initial 70, 80, 90, we are now into a butterfly 90, 400, 410. And we have locked in at least $400 on the trade. And of course, if you are lucky and the market would end up inside the tent, we can do something more. And here we actually sold the butterfly at 235. And then the exit was an additional 235. And I think the whole trade, just pull that up. So the whole trade basically returned $635, while we invested a total of $3,800 at the very beginning of the trade. So that's an example of the various steps in case, of course, the market goes in the right direction. If it's going in the wrong direction, we will very quickly turn it also in a butterfly or do something so to collect some premium and reduce the maximum risk. Now, another way that we will be doing in the next couple of days, or definitely in the next couple of weeks, is we start not with a backspread, but a variant of that backspread type, where also we'll be going with a long premium exposure from the start, but we will be doing a long delta, but the delta will be slightly smaller. And like here, the delta was probably around, let's see, it's probably around 2 futures. Yeah, here it is. So it's 105 deltas. So it's the equivalent of 2 futures. While we did, of course, a 4 lot instead of a standard 2 lot. So if you would be doing a +2, -2, +2, in ES, as you can see, we would have a delta exposure similar to being long one future, but of course with limited risk. And the limited risk in that case would be something like $1,900 if you would have done 2 instead of 4 contracts on each strike. But so that's the trading strategy in a nutshell. But of course, a lot depends on the timing. So when is the algo firing the signal? That's really critical, determines most of the success, of course, and then the adjustments. Because doing the trade blindly, just putting it on and hoping for the best, I'm afraid that wouldn't work. So it's really, really important to have good timing when to enter into that directional trading. And sometimes the width between the strikes is going to be 5 points. Sometimes it's going to be 20 points or 25 points, depending on the expiration. If it's an intraday trade, it's usually going to be 2 or even 1 strike, usually not too far away. And if it's going to be like a 5-day expiration, it could be like 20 points between, so 4 strikes between 2 of the options. I hope this helps explaining it.
Looks good. I don't see any more questions.
Okay, fine.
Any luck with the Ninja Trader stuff? Has that got its data yet?
Let me see. So, no, still loading here.
Wow.
Yeah. This is about 3 years of tick data, and it's on many different charts and on many different time frames. So that's why it's taking so long. I usually restart it over the weekend. So I had to do an update this morning, and that's why, yeah, it's still loading across the board. So
You're
usually
pushing your Ninja Trader pretty hard.
Oh yeah. Here is one, but that's on SPX. So it's a similar structure. So the charts are very similar as the one you see here. So this is the famous bias indicator that I've developed, which is on a scale from -10 to +10. And depending on where we go in terms of the distance, it will fire a signal, depending on the time frame and so on. But so this is the key feature that will drive the signals. So once we have like a bullish movement, for example, you can see here, like end of October, beginning of November, it flipped to, just pull up the data window, data box. So you see it flips over to like +4. That's not yet good enough. But once it's like +5, +6, like here, then we usually are in a pretty strong uptrend. So you see here that from that moment onwards, we have pretty good move to the upside. Here it's going against us temporarily, but not enough to exit the trade. And here we would definitely be out. You see the background is also changing color. So it would be out probably here on, this is on November 9, I think. So that trade, I would have applied this on this time frame on SPX, I would have entered probably somewhere here, so around 4,300, and I would have exited probably here around 43.75. So like 75 points over like a week of trading, holding the position overnight. And then here you would get an additional new trade, you see. The bias is going to 8 or 9. You see it's pointed here. You see it's +8. So that's a very strong long signal, and it would still be in the trade. So, and it's very similar to the volatility bars and Renko bars, but it's really quite universal. But I can't show it now here. I'm sorry.
That's funny.
But I had it, I think, on the previous presentation. So there, maybe I can quickly go there and see. So I had one example, I think, I'm not mistaken, in the trade examples. So you see here it's that's one of the strategies which is running. So here we had the buy signal. And so when this level was reached, and then here we had the sell signal. So that's a bad trade, an example of a bad trade. And here we have an example of a good trade. This is the short trade we had actually. So we went in and very quickly went out within 17 minutes or something. So it fired an exit signal like 25 minutes later. So we converted the trade into a back spread. So this kind of shape is what we will be seeing on Ninja. And we have a similar version of that running on TradeStation because I have everything basically on two different platforms. And I could show a TradeStation chart, of course, as well. So can you see the TradeStation chart? Yeah.
Yes.
Okay, so that's very similar. So here, that's another one. So that's one which started. See where the date is. Okay. So that one basically started on November 14. So went long here and is still in the trade. And then on the 15th, it exited. So that's a very similar story. And then it's flat since that moment. So previous trade, that's another long trade here. And that was, so I was in the trade for quite a while, I think. Yeah, this is a trade which started the 31st of October and exited on November 8th. And then you see here another one, which is a bad trade. So entering on October 27 and exiting the next trading day on the Monday. You see for a small loss. Here was another one, a short trade, tiny profit. Here was another one with a tiny loss. You see on the 27th in at 1642 and out at 1715. So this one actually, that's maybe a good example. I should explain that a bit better. So you see here on that trade, not only, so we went short here, and then the market went against us. And here we see on the same bias indicator, so the bias support resistance tells us to not only exit the trade, but actually reverse. So from a short entry, it went into a long reversal. And then that trade also actually, so we held the trade. We didn't get any exit signal. Then the market finally started to cooperate, but then here again, it flipped over and we exited the trade. But sometimes we can simply exit a short trade and just take the profit or the loss, or we can reverse from short to long. Sometimes there is a bit of space time-wise between the entry and the exit, like here. But here we went short, exited, and went short again. So it can be pretty active. And then sometimes it's quiet for a while. Here is another one which is basically going nowhere. So it's going short. Market went against us, but we didn't have any exit signal. And then here we exited. And then here you see another one. Several one actually. It's another short trade on October 20. So half an hour into the day, we got a short signal, went straight into the right direction, a bit of a retracement, but never threatened our stop. and then actually here, after this little bounce, it exited. So that's a short entry and a short exit. So you see how the bias went from, in this case, -7 to even -10 very quickly. So it's the absolute minimum, so very strong bearish trend strength. And then it started to get less negative, in other words, from -10 here to -6, -3, and then even 0. And then here it actually exited when it turned slightly positive, +1 or +2 actually. And then it abandoned the trade. So you see it's can be pretty active. So we won't be doing every single one of these trades, because then we could end up with quite a bunch of trades open at the same time. But so it's the same philosophy across different time frames. This is now on ES. And you see it's can be quite active. Huh? I hope this explains a bit the philosophy behind it. So it's really a question of trying to find directional strength to the upside or to the downside. And then, of course, be very quick at trying to control the risk. And so the backspread is usually the starting point is.
Eric asks, how do you determine a long-term trade for 1 day or 1 week?
Okay, so that's actually simple. It depends on the time frame. So we have the same algo running on different time frames. And if the time frame, say, assume it's a time frame which is using the equivalent of, say, hourly bars, and we get a trading signal there, then of course it's going to be like a 5-day trade or a 4-day trade expiration. If it's on a very short time frame, like the equivalent of, say, 10 minutes or 15 minutes, then it's probably going to be a day trade or a 1 or 2-day trade. So it's a question of what time frame we get the signal on. So we have this on different time frames. So we see it here on SPX4. This one is, for example, on 6. This is on 8. So the time frame to express this in minutes, it's a bit difficult. But for example, here you see from one bar to the next, from 1543, it goes to 1548. So it's about 5 minutes. But if the market is quiet, it can be like here from 1634, as you can see here, it's a time. And the next candle is only at 1712. So now it takes 45 minutes for the market to move up like 4 points. So depending on how fast the market is moving, we will get a signal and we will get new candles, and then the time series is being adjusted. So it's really a question of what time frame we are watching and where the trading signals are being generated. So for example, here there is no position, here there is long position, here there is no position, and here there is a short position. So it's overall it's flat here. See, this one is short, this one is long, this one is flat, so went out, and this one is flat as well. So depending on the time frame, it will be a longer position trade, say probably like 5 days or something, or it could be a day trade if it's like a very quick thing, like on this one. To give you an idea in terms of the length of the holding period, just pull this up. I can show you. So you can see here, how long am I in a trade? Average time in the trade, 1 day and 15 hours. How much time between trades? 1 day and 4 hours. So if I look at this one, it's going to be a bit different. Yeah, 1 day and 11 hours, 21 hours. Look at this one. One day and 7 hours in a trade, 20 hours. And this one, for example, it's also about a day, about 1 day, 23 hours and 29 minutes. It's in an average time between trades, it's about 3 days, 2 days and 22 hours. So that will depend on the time frame. Sometimes there is more activity, but on average, we can say that the longer the time frame, the longer the position and the options that we use. So in terms of performances, they are a bit similar, but you see there are many losing trades. It's about 50-50 most of the time. So here it's like 40% winning trades only. But then you see it's a ratio of about 3-1 between winning trades and losing trades. If I take this one, it's going to be about the same thing, but here it's about 4-1 win to loss ratio, 4,500 on a winning trade, $1,100 on a losing trade, and about 40% winning trades. So most of the time we are seeing a losing trade, but the losses are not going to be big. Take this one, 3.71, 4.49, 45% winning trades. The chart, so these are the last 40-50 trades. So it's sloping up from bottom left to top right, which is a good thing, but still there are some decent drawdowns. So it's not like it's, you see $7,000 drawdown. This one, probably 10,000 or something, 11,000, you see, 10,000. So, but then it's, what is important, of course, is the ratio between total net profit on the trade and the maximum drawdown intraday peak to valley. It's about 6-1 here, 6.38. And we try to get at least 3-1. And that's what we usually achieve, 3-1 or 5-1, somewhere in that order. So here is an 8-1, 5-1, 58,000, 11,000 drawdown. See here it's 8-1, 57.7. So that's quite good. So the graph is looking very good. And this one, I think we already looked at. So it's not that the trades make a lot of money individually, but it's sometimes you can have a huge trade, but sometimes you're just plugging around and it takes a while before they are generating some profit. So here it took like 20 trades to make the $10,000. So it's about $500 per trade after 20 trades. And then you could have a couple of really good ones. For example, show the trade list. You see, so minus 2,400, minus 3,000, plus 6,900. And that's using the equivalent of 2 futures. So always 100 deltas. So on average, when we are trading, it's about 50 deltas, 100 deltas on the signals that we will be posting on Slack. But so it's really a series of losing trades and winning trades. So it's not like, you see the length of consecutive winning trades as well. See, you can have like 4 or 5 losing trades in a row. It's not exceptional. So it's important to stick to the system and try to take every single trade. Now, of course, we won't be trading every single trade because we will be using only one open unhedged position at a time. But so every time a new one comes along, and there is really no advantage to saying, well, I'm going to use this system or this time frame or that one. It's all similar and comparable. So it's not like one is definitely superior to another one. They are all about the same. So, Tom, you see any other questions popping up?
I don't. So
Okay.
we're coming up on an hour. So why don't
Very
we
good.
wrap it up?
Okay, excellent. Well, thanks for the time and for your questions.
Yeah, just a
And
quick summary. The trial will continue through Wednesday, and then
yeah,
the live set service will start on Monday the following week after
absolutely.
Thanksgiving.
Okay, and I think with Slack it works pretty well, because it's very fast and people can ask questions in the separate the general discussions portion, and I will post all the trades in in the slingshot trades one.
Perfect.
So it's really working fine. And with the tool as well, I think. So that's really very
Yeah,
convenient.
I made that change we talked about. So if you
Okay,
have a strike with 0 contracts, it just ignores it.
super. Okay,
Okay. If
excellent.
you need any
Well,
changes to that tool, let me know, but I think it's working well.
okay, I will. Thank you, Tom.
All right,
Okay,
thanks everyone. I'll get this recording posted and then I'll also put a link to it in Slack too, just make sure it's easy for everybody to find.
okay.
Oh, and
So,
then Eric has one more question.
sure.
Is the best performance on futures or options?
I think the best performance in dollar-wise, return-wise, is on futures. Risk-adjusted return, it's better on options.
There we go. All right. Well, thanks, Luke. Thanks for
Okay,
everything. Really appreciate it. And we will see you guys next week and have a good weekend.
okay, you too. Thanks, Tom. Bye now.
Thanks.